So I get a lot of questions from people um, that are interested in purchasing an investment property. And there's a lot of information on the internet as to, like cash flow, put your money in real estate and, replace your job, replace your income, et cetera, et cetera. But there are different levels of investing in real estate itself, right? And everybody's goal is different. What you want out of it is different than what the person that may have told you about investing in real estate, what their goal was, right? Um, so one of the reasons why people want to invest in real estate is to have cash flow, right? The most popular loan type in investing in real estate for cash flow is what's called a DSCR. DSCR stands for debt service coverage ratio. In a nutshell, it's a loan that's designed that what happens is when the rental money comes in or the rental comps come in during the appraisal period, as long as the home can show that the rent can cover the mortgage payment on a 1-to-1 scale, right? Then typically that's all you need to be able to get approved for a DSCR. So it's mainly based on the potential rental that the property can produce. Okay. And of course you've got to have, a decent credit score. I mean, the lower the credit score, the higher the interest rate is going to be, and the more difficult that it's going to be for that coverage ratio to cover. Like you can say, well, if I'm paying a $1,800 mortgage on this property, and I'll just make sure that I charge $2,000, right? But that's not the case. You got to be able to rent it. So you've got to know the local market, right? Or just make sure that you have a real estate professional in that market that can tell you what this thing can rent for. Sometimes there's properties, very rare, that are already cash flowing, right? And then you can purchase that. But just because it's cash flowing for somebody, let's say $500 a month, doesn't mean that it's going to be the same for you. They might have put more down. They might have a different interest rate. They might already have different kind of equity in the property, et cetera, et cetera. It can all be different. So it's got to be real time market information on the house, on the property. Um, but on a single family residence, you're not really going to be cash flowing a whole lot of money. And then the money that you are cash flowing, you've got to set aside a percentage of that just in case there's any kinds of repairs. You got to be able to still pay the mortgage if there's any vacancies, periods, and and things like that. So if cash flow is what you are looking to do, most of the time, um, you'll be disappointed by how much cash flow it can actually produce. Now, if you are just, I have this amount of money in the bank, right? And I know that leaving money in the bank is not really, it's really losing money at the end of the day because you're not making any money from the money and it's losing its value as days goes on, because of inflation and other reasons. But let's say because of inflation, it's not really keeping its value or gaining value. So you put it in real estate the same way that you would put it in like stocks, right? And not to get technical as to which produces what or whatever, which is better. I'm just saying, like a real estate is known to actually produce and appreciate in value. So let's say you have your 30, 40, $50,000 that you have saved up, whatever it may be, 20,000, whatever it may be, right? You put that in the bank, it's losing value. You put it in real estate, even though you're not cash flowing, right? You're not really cash flowing. If it's like $200 profit that you're making, you want to probably be saving a lot of that. So you're not replacing your income, but your money is not losing its value. And then you're gaining equity in the home and the property itself. Okay. So it's a safe place to put your money in. Okay. The same way that you can do it in like in the S&P 500 or, things like that. Right. Or in, some good stocks and, crypto if you go that way or whatever. But, I'm just talking real estate itself. So that's number one. you'll be more likely to have some income producing properties if you get into the more multi-family sort of investments. And those prices are a bit higher, a lot higher than, a single family residence that you can buy for, let's say, 250, $300,000 with 20% down, versus a multifamily, and multifamily, I mean more than 4 units, five, six, seven, 8+ units type thing. Those properties are going to be a lot higher in price. So the down payment is going to be a lot higher as well. So yeah, so that's number one. Some people actually want to get an investment property because they want to do short-term rentals, Airbnb sort of thing. Those may cash flow a little bit better, typically do, but you've got to find the right house, the right property, the right location, and then there's management as well. So you want to have somebody, on the ground basically that can manage the property for you if it's not local to you, and that comes with a cost as well. So yeah, it can cash flow a little bit better, but some people do this because they just want to buy this investment property, short-term rental, because they want to be in a place that they actually like to go in and vacation in once, twice a year type of thing, right? So that's another reason why people do that. And the way that basically works, depending on the credit and experience, et cetera, the average down payment is 20%. In some instances, it's going to be 25%. And in some very rare instances, right? Well, not even rare, but sometimes it's credit based, right? It's a very low credit score, and the lenders might find it as too much of a risk, so they might want to be at 25 and 30% down, but typically you're looking at 20% down plus closing costs. Okay. I say make sure you have 25%, and that can typically cover the down payment and closing costs that you need to be able to close on a particular property. Okay. So let's say 25%. So whatever number you're looking at, if you're looking at a $300,000 house, have $75,000 to the side that you can actually, have your down payment and your closing costs covered, and you don't have to worry about it, right? Plus, banks also like you to have some sort of reserves. It looks better on the file, right? So keep it at 25% or higher, right? And you should be fine with that. The process is not very difficult. Again, it's we have to do a regular appraisal, and then we have to get a rent schedule as well. It's part of the appraisal. Those appraisals are typically, let's say, $800 or so, for the appraisal, because we also need the rent schedule on it as well, and the market rent. Um, that's an out-of-pocket expense that you're going to have. It's part of that same closing cost. And then you'll have, of course, you're going to want to have an inspection done. Inspection is typically, $300, $350, somewhere around there, depending on the city that it's in and how remote a specific thing may be. But average is about $350 or so. Um, and then some, a lot of these houses, they have a survey done as well. Those are three of the things that you're paying for up front that are part of that closing cost, but those things are not paid at closing. They're paid before closing as you're going in through the process. um, there's not really a lot more to qualifying for a DSCR. There's, the fact that they don't want to see any mortgage lates if you have a mortgage on your home within the past 12 months. No 12-month mortgage lates, that does affect. If you've got any bankruptcies, we want a seasoning period. Most banks want to wait 2 years before any sort of major event like that, like a bankruptcy. Foreclosures have their own, uh, um, waiting period as well. So major events like that, they typically don't like to see any negative reporting on government debt, IRS debt. Not that you can't have an IRS debt, but at least that you're up and paying for it. Same thing with student loans, that you're not in default of any of these types of loans. But other than that, I mean, it's not really that complicated of a process for the DSCR, that buying. So and the interest rates are going to be a bit higher. Typically, I see around 2% higher or so as an average, right, than regular primary mortgage or a regular conventional mortgage. And reason is basically they're like it's the lowest interest rates go to primary residence because lenders feel like that's the home you're going to protect. Then after that, it's investment properties. And then after that, it's vacation homes. So that's typically the order as far as how expensive these loans are when it comes to interest rates themselves. DSCRs also have most of them have a prepayment penalty to them, right? And all it means is that there's a amount of money that you're going to end up paying, a couple $1,000 sometimes if you get out of the loan, if you sell the property. If you refinance the property, there's typically just a penalty within that. And sometimes it's 5 years. The industry norm is about 3 years. And if you want it to be like a no prepayment penalty, then most lenders will do that, but they'll upcharge on the interest rate itself. And I mean, that's basically it. Real quick, a cool thing about the DSCR also is that you're not going to be paying any PMI or any mortgage insurance on it as well, because you're in it with, a 20% equity already with the down payment. So application is pretty simple. It's 2 months bank statements to know where the assets are coming from. A credit pool, and that's another thing that we charge up front for a credit pool. It's like $60 or something like that. And then and just start looking for a property. As long as you got the credit and the cash, it's start looking for a property, and that's pretty much it.